The market has had a sluggish start to the year with the Dow index essentially flat and the S&P 500 barely up 1%. Investors have been jumping into defensive stocks as they're unwilling to take on risk. As a result, this earnings season has the potential to either bring back investors or scare them away. Robbert van Batenburg, Director of Market Strategy at Newedge, points out that many companies in the S&P 500 have lowered their earnings estimates for the first quarter. Now, Robbert, do they do this because they want to underpromise and overdeliver? I mean, so that they can beat expectations?
Yeah, that's been the going trend. Companies manage their earnings expectations downward throughout the quarter. Of course, there are always also some exogenous factors that are playing a role here. You know, many people have blamed the weather this time around. Of course, China is very obscure right now in terms of growth. The growth has definitely slowed down in the first 2 months of the year. What we're looking at, obviously, is the trade data that came out last night underscored that, you know, at least GDP growth there is continuing to slow down. So these are kind of like one-off factors that have actually driven more companies to lower guidance and lower financial expectations than ever before, or at least in the last 5-6 years.
And you bring up a good point, because some companies, they lower their estimates and yet they don't seem to really get affected by that. One of them would be First Solar. That company has definitely they've lowered their estimates 32% over the last 3 months. The stock has outperformed its sector. It's up 5%.
Yes, and they're not the only ones. So sometimes, you know, the investment community throws caution to the wind. They accept that at that point the company reports lower earnings or disappointing earnings. They're looking forward. They're hoping for a rebound. And it so happened that, you know, throughout the cycles, we've seen companies reporting disappointing results, and the street investors looking completely beyond that and, you know, buying the stock for recovery in earnings further down the road. So that could partially explain it. In this, with respect to First Solar, it's been there's a lot of high flyers, a lot of momentum stocks that have been chased. Of course, we all know the 3D stocks, the Netflixes, the Amazons of this world, and a plethora of technology stocks as well. I think that's partially explaining why First Solar has made such a dramatic run-up in the recent quarter. But still, it's amazing to see.
And then Urban Outfitters is another example of that. That stock had their first quarter estimates drop 22%. Now the stock is down, but only 3%, while the whole sector is down 4%.
Right, yes.
So they must like Urban Outfitters better than they like the other retailers. Now, on the other side of that coin, we've got, say, an E-Trade, which with E-Trade, their estimates are up 32% over the last 3 months, but the stock is down 4%.
I know, yeah. No, with Urban Outfitters, it's, you know, this is the retail space, and it's very difficult. I mean, retail has been disappointing. This is where the weather does play a role. There are a lot of retailers that got affected by the elongated winter effect, and people just not, you know, buying for spring. So people, you know, investors are more forgiving there, or tend to be more forgiving in certain instances. With respect to E-Trade, this is a textbook example of, you know, the company has become a victim of this hype around the high frequency traders, because E-Trade gets a lot of flow. They pay for flow, and they get paid for, you know, to show this flow to investors. That is, you know, a large part, or at least a significant part of the revenues and earnings. And now people are starting to think, well, wait a minute, if they start to clamp down on these high frequency traders, then E-Trade may get affected by it. So that's why the stock has, even though earnings expectations have continued to go up, which is actually a rarity in the financial sector, because overall financials are expected to, you know, report very lackluster results. And this is in stark contrast to what we've seen in the last couple of years, is where the financials actually have driven overall S&P EPS higher. They were the leading group because they've been writing back up all these non-performing loans and all these reservations they've made in the prior years. And, you know, obviously there were non-cash earnings, but there was a lot of earnings growth nonetheless. This time around, and Wells Fargo and JP Morgan were the first banks to report tomorrow. A lot of people will be looking at that, but I don't think many people expect a firework from them. Investment banking has been lackluster. Fixed income and equities trading had all been down. So kind of like it's taken out of the spotlight of financials.
All right, well, investors, if you are looking at these earnings, definitely keep in mind all those outside forces because that can affect the stock more than the earnings. And that is Robbert Batenburg from Newedge. I'm Deborah Borchardt with The Street.